37.1%. AMC up now by 2%. Again, recapping stocks lower, S&P down 20, a drop there of 0.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, I can't quote Twitter shares anymore because, as you know, of last Friday, Elon Musk, now the owner of Twitter, and seemed to move quickly in the last couple of days to already make his presence felt and his voice on social and in the real world definitely heard. So Bloomberg News senior executive editor of Global Tech, Brad Stone, as he writes in his newsletter, Twitter is the apple of Elon Musk's eye. Brad is the author of The Everything Store and also Amazon Unbound, and he joins us via Zoom in San Francisco. Brad, great to have you here with Paul Sweeney and myself. So tell us about what you were thinking when it comes to Twitter and Elon and another very well-known company and kind of the creative genius behind it.
Sure. Thanks for having me on, Carol, and thanks as always for your kind words. Well, you know, there are no shortage of Twitter takes these days. We're writing about it basically every day. And for our Tech Daily newsletter this morning, I just thought that something about, you know, Elon's takeover of Twitter reminded me of Steve Jobs' return to Apple way back in 1996. So I'm dating myself. But, you know, Apple at the time, it's like 4% market share. It matters much more culturally and politically than it did financially. If you remember, Microsoft was investing in Apple back then, kind of propping it up because it didn't want to be seen as a software monopoly. It's very similar to Twitter today, kind of an also-ran and another CEO coming back, not a founder, but a CEO with a messianic view of Twitter's importance, very much like how Steve Jobs viewed Apple back in the day.
I mean, the hard part, I mean, a lot of stuff I read, Brad, over the weekend was basically along the lines of, okay, Elon wanted it, I guess, but boy, now he owns it. Now's the hard part. Do we have any idea whether he has a plan to do anything? Because I felt like, as I think back to the Steve Jobs, I felt like he had a plan. I'm not sure Elon has a plan here.
Exactly. And as I sort of write in the piece, now that we've interrogated this straw man, let's set him ablaze. And that's what I do in the piece. And no, I mean, you know, Steve was a co-founder of Apple. He knew the personal computer market intimately. Elon's coming at this with as a user. Everything that he's kind of tried to articulate for the platform seems sort of ill-advised. You know, right now it feels like, you know, one thing they're doing is planning to cut back on the number of employees who work at Twitter. So, you know, maybe about 50% of Twitter's employees are about to be let go. They're considering things like charging for those blue check marks, verified users. The reaction to that on Twitter isn't very positive right now. And then, of course, this kind of free speech maximalism that he's articulated and the sort of like poor humor he demonstrated over the weekend, retweeting a Paul Pelosi conspiracy theory, you know, that's played very poorly. So no, I mean, it's very early, but we certainly haven't seen much in the way of a coherent view for how Twitter can, you know, be put on a stable path to growth again.
Hey, Brad, you see similarities, but you also see some critical differences between Jobs returning to Apple and what we're seeing with Elon Musk and Twitter right now.
Exactly. And like one difference, I think, is that people really wanted Apple back in the 90s to succeed. I'm not so sure that's the case with Twitter right now. I mean, even the frequent users feel all sorts of tied up and ambivalent about it. It's a sort of bad addiction that no one can quite crack. And, you know, the indication so far is that it's the quality of the discourse, the level, is going to get even messier and uglier under Elon's ownership. And, you know, if that's true, that would be unfortunate.
Can I just,
sure, yeah.
One quick follow-on. I wonder, Brad, is there something different in that Steve Jobs created Apple? Elon Musk did not. He likes using Twitter in a big way. We know that, but he didn't create it. Is there something about not being maybe the founder that could be a difference here?
Yeah, I mean, Twitter had its own prodigal founder returning when Jack Dorsey came back and resumed being CEO. I think the education ramp up is going to be much steeper for Elon because he doesn't really know this company. And the things that he's concluded as an outsider, I feel like are going to be much more complicated. You know, things like just content moderation, how to hire employees, keep them motivated. When there's a real missionary sense at Twitter that they were trying to, you know, make the world better. No, I think that it's going to be a much steeper challenge than even it was for Steve Jobs taking over a very wounded Apple in the mid-90s and returning it to glory.
Just real quick, Brad, any sense in the Valley how much leeway people are going to give Elon to turn this thing around?
I mean, well, the fact is that he really doesn't need anybody to give him leeway.
True.
I mean, he's taken it private. It's not a matter of cultivating investors anymore, other than the ones he's already conscripted into a syndicate. And so he does have a little bit of runway. I think he's going to have to convince users, right, to stick around, to devote more of their time to this platform. That's the big challenge.
Well, GM has already put him on notice in
Yes.
terms of advertising, so we shall see. Brad Stone, thank you so much. He is Senior Executive Editor of Global Technology here at Bloomberg News, author of Amazon Unbound, Jeff Bezos and the Invention of a Global Empire. The book before that, The Everything Store, Jeff Bezos and the Age of Amazon.
Read both of them.
Yeah, right? Incredible and everything you want to know. All right, you are listening to Bloomberg Business Week.
All right, let's head down to Washington, D.C., World and National News with Nancy Lyons.
Thanks, Paul. The Supreme Court is taking up affirmative action practices at universities. Conservative groups have sued both Harvard University and the University of North Carolina, claiming that their admissions policies are not fair to white or Asian applicants. During today's arguments, Patrick Strawbridge, representing Students for Fair Admissions, called for the policies to change.
Racial classifications are wrong. That principle was enshrined in our law at great cost following the Civil War. A century of resistance to race neutrality followed, but this court's landmark decision in Brown finally and firmly rejected the view that racial classifications have any role to play in providing educational opportunities.
Again, Patrick Strawbridge. Advocates say affirmative action creates diverse learning environments and benefits students of all races. Well, the man accused of attacking Paul Pelosi, the husband of House Speaker Nancy Pelosi, is facing 2 federal crimes: attempted kidnapping and assault. Police say David DePape told them he wanted to hold the speaker hostage and break her kneecaps, but she was not at home, and DePape allegedly attacked Paul Pelosi with a hammer. Pelosi was seriously injured in the attack. Witches are casting a spell on Google's list of most popular Halloween costumes this year. With Halloween upon us, Google Trends is out with its 2022 Frightgeist list that takes a look at the most searched for costumes in the U.S. For the second straight year, Witch comes in at number 1. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our Washington, D.C. newsroom. Carol Masser, along with Paul Sweeney. Paul is host of Bloomberg Surveillance and Bloomberg Markets, earlier on Bloomberg Radio. He's doing a really long shift for us right now.
Good times.
I love having you here, as always. Couple of iPhone stories.
Yes. I mean, the shutdown, the COVID-0 policy in China is vexing on so many levels, and I don't know how the good people of China are dealing with it for so long. And this story has to do with Foxconn, the iPhone factory. This iPhone factory worker, sensing that that the whole Foxconn campus and complex was going to be shut down, walked 25 miles home with luggage because this person did not want to get caught up in yet another lockdown. And it just kind of goes to the issue of, as we think about the global supply chain, there's the human element there of people having to deal with these lockdowns on going into year 3, but also the economic implications, and in this case, the iPhone, which everybody has.
It's interesting. I feel like we've learned, a lot in terms of how China's been handling COVID increasingly. And we just see, this talk specifically about this Foxconn factory that went into a closed loop, so basically walling off the giant complex from the outside world. They had trash piling up in hallways. Food was harder to come by. Many who got infected said they were forced to subsist on bread for a spell. So it talks about the specific worker, Dong Wanwan, who decided to give up her job at the world's largest iPhone factory and just walk home.
Yeah, and these are good blue-collar, high-paying jobs in China. But it just goes to the issue of, you've got Foxconn, the world depends upon the phones coming out of there. So in addition to the human toll, there's this economic toll and global trade toll, and you just don't know how long they're going to do this. You could make the argument, I'm not a doctor, but this could never end, maybe.
Well, and it's interesting. The exodus of workers who are leaving, now it looks like Foxconn has been, raising wages to basically bring workers back in. So they know they need those workers to get stuff done.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pella. 13 minutes to go ahead of the closing bell. Tech dragging stocks down. However, we are well off session lows. The S&P now down 19 points, a decline of 0.5%. NASDAQ is down 87, a drop there of 0.8%. The NASDAQ 100 index lower now by 1%. The Dow Jones Industrial Average down 61, a decline there of 0.2%. The 10-year 4.08%, while the 2 years at 4.50%. Stocks are falling as Treasury yields jump. Investors are awaiting Wednesday's Fed decision for clues on whether officials will dial back the pace of rate hikes as early as December. Spot gold down $12 the ounce, now down 0.7%, 16.32. West Texas Intermediate crude down 2%. 86.15 a barrel. Lots of earnings after the close of trading today. Among some of the names, we'll be hearing from NXP Semiconductors, down now by 3.2%. Rambus up 0.7. Boise Cascade down 0.9. Goodyear Tire higher by 1.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, so appreciate it. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. Ukraine's government has received more than $60 billion in assistance from the U.S. since the Russian invasion. Now, some Republican leaders want to toughen oversight over how those funds are being spent. They're right to do so. Washington has accounted for 2/3 of all military and humanitarian assistance offered to Ukraine since the start of the war. Supplies of American-made weaponry have enabled Ukraine to withstand Russia's initial onslaught. It's imperative that the U.S. ensure the money is being properly spent. With government spending already a campaign issue ahead of the midterms, it's inevitable that lawmakers, including some Democrats, will insist on greater transparency as a condition for more aid. The bipartisan support in Congress for assisting Ukraine has been indispensable to the country's survival in the face of Vladimir Putin's assault. Greater transparency over the flow of U.S. aid will help to ensure it lasts. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Love the tunes you guys have on the show. It's always
We got
great.
the cool stuff.
I know. I missed the
Dave Wilson?
Dave Wilson. Yeah, I missed that. We need to bring
I'll
that
have to
back
bring it out every
occasionally.
once in a while.
All right, first 9 months of the year, let's just forget about it. I mean, stocks down mid-20s, bonds down low teens. So we had a little bit of a bump here in the month of October. We'll take that. The question is, where do we go from here? And what's going to be the drivers to move this market forward, one direction or the other? Let's check in with somebody who does this stuff for a living, JJ Kinahan, Chief Executive Officer of IG North America, joining us on the phone from Chicago here. So, JJ, thanks so much for taking the time here. October's been pretty good for equity investors here. Should we get used to it or kind of get back to the old ways?
I don't think you should necessarily get used to it. It's a pretty amazing month, you know, as you guys have reported many times. Looks like it's going to be the best Dow month since 1976. That all said, it's a great breath of fresh air, if you will. But the earnings season, which so far has been pretty good, I think also has given us some forward-looking statements that may make us a little bit more nervous, and it may be until January and February where we start to see some of those things come home to roost, if you will.
Yeah, remember when like bad news was good news because it meant the Fed was going to keep rates low? We're in a different environment, and even if we get some bad news, right, we're going to get that monthly jobs report, JJ, on Friday. The Fed has been pretty clear that it's going to continue raising rates. We're not done yet. What does that mean for the earnings outlook for publicly held companies?
Absolutely, and Carol, obviously we have this week an 87% probability of a 75% rate hike.
Right.
I think we've already kind of built that in. But you saw companies like Procter and Gamble come out with incredible earnings, really 7% organic growth in a company that size, just amazing. But their CEO adds in their call, we expect that we're going to have slower growth, because one of the reasons being strength of dollar, and you're starting to hear strength of dollar a lot more. And again, as your listeners think about it, the rates going up make the dollar more valuable versus foreign currencies. So in an inflationary environment anyways, it means companies overseas are either going to have to find cheaper alternatives or do without or order less of these products. So once we start to see the demand side get hit, that's not a good thing. And as I said, I don't seeing it yet. I think we may have to turn the calendar a year before we really start to see some of the ramifications. And that actually goes for all these interest rate hikes also. It usually takes 6 to 9 months for these rate hikes to get through the system. So we're just starting to see, in my opinion, the beginning of some of the ramifications for the economy overall. I'm not doom and gloom by any stretch of the imagination, but I do think that you have to continue with a cautious note as we head into the year end.
Hey, JJ, we had a kind of a rough week in the world of technology stocks last week. We had some disappointing earnings from some of the stalwarts on the software side, like a Microsoft, which was a little cautious in its guidance. And then, of course, Meta and the other social media companies calling out weak advertising, which I guess shouldn't be a surprise with an economy going into a recession. But did that change your view of technology? Because it's been kind of a leading group for well over a decade now.
Yeah, it's really pretty amazing how we've kind of gone from, it seems like the old guard, if you will, a little bit is in charge. It's some of these Dow stocks that have done well. And I do have to say, I think if I'd have said to you before last week, these are how the tech stocks are going to perform, you'd have thought last week would be a wreck. And instead, you had the Caterpillars and the Coca-Colas of the world coming through to save the day, if you will. And so I do think what's going to have to happen is we're going to have to perhaps find more leadership. And so for that, quite honestly, I look to the financial sector, which hasn't quite performed to the level I think many of us would have liked to. I think what we hope to see as the end of the year comes in the beginning of next year is a more normalizing of that yield curve where the 10 years trading over the 2-year. And I think with that, we can start to find the leadership that we've been looking for. Right. And the tech, let's face it, really hasn't provided us at all in the last couple of years.
JJ, how do you factor in, though, that it's a good chance that inflation doesn't go back down to maybe a 2% level, or the Fed funds rate doesn't go back down to 2%, but stays maybe around 4% or so, that is the new norm? Because as we continue to move forward, I keep hammering this because it just makes sense to me that we are living in a different environment in terms of geopolitical, supply chains, climate change, aging populations. All of these will have an impact and probably lead to strains on the system. So how do you think about that and investment strategy going forward?
Well, I think one of the things that you are seeing right now is sort of those dividend-paying stocks, as I talked about the old guard being more popular, at least in the near term, tends to be a little bit of an inflation hedge. Along with that, those who trade options using covered calls against it to enhance their returns seems to be something we're seeing quite a bit more of. And I think, as you talk about it, Carol, there's just so much changing at once. What I would also say for people is as you invest right now, you may really want to think about being more of a partial rather than an all-in investor, because I would also say with that, the VIX is going to stay to a bit of an elevated level. Right now, the VIX trading about 26, telling you that you should expect about a 1.6% move every single day in the S&P 500. So people have, even if they're not trading these products, they have to understand what these products are telling them. And what the products are telling you right now is that as you look out toward the next 3 months, we should expect these 1.5 to 2% moves in the S&P 500 or the SPX on a daily basis.
So, JJ, just real quickly, what's your call on valuation? How's this market valued?
Well, it's really tough to say. Well, it's clearly fair value. I guess you would have to say that with all that is changing, I you know, if you're a believer in efficient market, you would say that it's always fairly valued. But so much is changing. I think you have to be very, very careful. Especially to me, I guess the better way to look at it is when you're looking at these earnings calls. I use Procter & Gamble as an example earlier, but many. What are they saying going forward? Because that's really what you have to say at the valuation, and many of them you're going to have to discount going forward because of that. We
need to know about outlooks and what kind of transparency and visibility they've got. Hey, JJ, thank you so much. JJ Kinahan of IG North America. All right, time to head over to our TV colleagues for our cross-platform coverage beyond the bell on radio, TV, and YouTube. We're counting you down to the close.
On the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And just about 2 minutes away from the end of the trading day, Caroline Hyde, Taylor Riggs, counting you down to the closing bell, here to help us go beyond the bell. It's our global simulcast. Carol Masser, Paul Sweeney in for Tim Stenovic, bringing together, of course, our various platforms, whether you're watching on TV, you're consuming on radio, YouTube, or Quick Take. We go around the world to dissect what is an extraordinary month for the Dow Jones Industrial Average, Carol.
You know, it's so funny that you did that. Just before we got going, I was looking at all the monthly returns, and you're right, the Dow is up 14% for the month overall. Russell 2000's up about 11%, S&P's up 8%, and then the NASDAQ 100's up about 4%. But you're right, Caroline and Paul, like, that's the outperformance, the Dow Transports, not the Dow, well, Dow Industrials.
It has been. It's been the Dow. It's been some of those names like Caterpillar. If you think about on the flip side, the technology sector, which has been obviously a market leader for years and years and years, feeling the pain here. And of course, we're still feeling the pain, I think, from some of those tech earnings we had last week, which I think for some investors may have called into question their continued support of some of these tech sectors.
We've talked a lot too when we think about the end of the trading month and the size and the scope and the superlatives, the relative underperformance of the NASDAQ 100 relative to the S&P 500. I think we're on track for about maybe the second to worst month that we've had since about 2008. So you're really looking at, well, maybe more equal weight indices or Dows in this case, is that big tech we really saw last week had been pressuring the majors.
And Taylor, it's a lot about the bond market, right?
I mean, this is unbelievable. When you think about the moves and the rate of change, this is now the third straight month that we've had on both the 2s and the 10s where yields have been rising, and it's another month of 20, 30 basis points that we've seen.
And that is why the NASDAQ is under pressure. It's under pressure on the day again. 6 seconds until these market bells, they ring the celebration of what has been an extraordinary month, but not so much for the NASDAQ. We're currently down 1% on the day, and we are up just 3.8% on the month. We currently have the S&P 500 off by 0.75% on the day. No bells. We'll bring them to you in a moment if we can.
Must be a Halloween thing,
I know, spooky.
Ooh,
I feel spooky without the sound system going. But we are having an S&P that's off by 28 points on the day, but as we say on the month, having a stellar month, up more than 8.5%. The Dow having the best month since 1976, folks, up 14%, but on the day it's just off by 0.4%. And let's bring it out to the Russell 2000, because you so smartly point out, Carol, it's had a phenomenal month too, up more than 11%, but on the day, it too is in the red.
Yeah, it's pretty remarkable. Like, you look at this, and I was thinking about, I mentioned transports by mistake, but they were up like 12, 13%. And I do wonder, you know, ultimately, what does that say about the economy, right? Right, when you see these names, Taylor, this sector, it usually is a sign that, you know, the economy's doing okay.
Well, take a look at this, Carol, when you think about a few sectors underneath the surface. And for the day, actually, things looked a lot worse than typically what a 0.7% of a decline on the major average would tell you. Carol, to your point, it's energy and it's healthcare and it's hardware equipment and it's services. Those are the only two sectors, of course, in the green. Everything else is in the red. I want to come down to the bottom of the screen as well. We've been having really interesting conversations, I know, about big tech, the role of big tech in a portfolio as yields are rising. And as you can see, I mean, it is software services, it's technology hardware, it's semiconductors, and it's media and entertainment. And those are the sectors that are off still about 2% or so on the day. And I think the month looks a lot worse.
Man, Taylor, what a flip from what we saw in terms of Friday. We saw so much green and such a different tone in today's trade. All right, let's get to some of the individual gainers. And Wynn Resorts, I talked about casinos earlier. Wynn Resorts, top in the S&P 500. This was up about 9.6% by the close today. Billionaire Tillman Fertitta, he's got a stake, 6.9 million shares, a 6.1% stake. He already is in the casino area, and this is going to make him the second largest individual investor in that company. So that was an outperformer. The meme stocks, we were talking about this. Apparently, they go away for a little. Right, exactly. Here's one that we don't always talk about as much, but Getty Images Holdings, it was up almost 50% in today's session. It's about a 2.6 billion market cap, finishing the day with a 35% gain. It went public earlier this year after merging with a blank check firm. It's still down more than 30% so far, though, here in 2022. And one more, a Chinese name, Pinduoduo, up about 3.5%. Top of the NASDAQ 100. Couldn't find anything specific beyond one of our media competitors talking about a report that notes this name, PDD, and TikTok owner ByteDance launching international cross-border e-commerce websites. So U.S., Europe, so maybe looking to expand their footprint as they try to look for growth beyond the Asian market. So that's some of the individual gainers. Paul, what do you got?
All right, some of the names that struggle today. Let's just go right to the technology space. Lots to choose from. Global Payments Network, another one of those electronic payments companies, typically high multiple stock. They had some weak results coming out this morning, so that stock took it on the chin here. Then you look over to a name that maybe is a little bit more well-known in the e-payments business, PayPal. I think they were trading down in sympathy to the GPN numbers. Also, a big block of stock traded for PayPal this morning, so that was interesting to see. So maybe a little bit of somebody getting out of the name. And then, Meta, down again another 6-7% here. I think what's happening here is a lot of people are looking at this company and saying, boy, I've got a company that's talking about slowing revenue growth at advertising because of a looming recession that a lot of folks are talking about. At the same time, I've got a CEO who's talking about continuing to ramp up expenses on a business, that being the metaverse, that most people don't even know what it is. So that's a tough times there for Meta.
7-year low, as we're seeing currently on the screen right now. Extraordinary moves in that stock. Let's have a look at what else is having an extraordinary day. And really from an FX perspective, King Dollar is back. We all focus on the future, of course, the Wednesday, the Federal Reserve, what Jay Powell will really have to serve for us, whether he will tempt down any expectation of a 75 basis points going into the future. We're basically locked in for this particular month. We're seeing a dollar index, therefore, strengthening, a British pound weakening by 1.3%. We're continuing to see some weakness over in the euro, weakening by 0.8%. That happened higher into that CPI and GDP print, but then the CPI comes in hot and the GDP only growing 0.2% for the quarter. So all in all, a pretty gloomy picture. The euro weakens. I'm looking at what's happening in terms of commodity space, and this is a reflection of the weakening in the China growth story. Once again, zinc off by more than 3%. We see that overall WTI crude being dragged lower by the warrior in demand coming from China. We're off by almost 2%. $86.18 is where we trade on the WTI contract. And we see natural gas, pushing higher by some 11%. The volatility still front and center for natural gas. I'm looking at sovereign bond space that really was yields higher across the board. In Greece, up 19 basis points. Over in Asia, we were trading up by 8 basis points as well, Taylor.
It is wild, Caroline. When you think about the month that we've had, take a look really with the big focus on the front end of that yield curve. In the last 15 months, two-year yields have jumped in 13 of those. There's only been 2 months in the last 15 where two-year yields actually declined on the month. So I bring you the latest 20 basis point moves on the 10-year, also rising in the last 3 months consistently, up 24 basis points. So Carol, this really thinks is a day, of course, here we're ending with yields rising. This has been a monthly story and really the last year story as well. It's a big focus on what the terminal rate is, the direction, the rate of change for yields, what it means for Federal Reserve, and sort of the message that they continue to give us on Wednesday.
Yeah, I think that's such an important point. Our Anna Wong writing about this specifically, saying that she and the team think that we'll get from the Fed and Jay Powell on Wednesday that maybe they are talking about 50 basis points come December specifically, but that the tricky point will be that, listen, maybe we're going to do slower rate hikes, but it doesn't mean it's a dovish pivot, which Paul, the markets are going to run into saying, okay, things are changing, things are changing.
Exactly. We saw that movie before back in July. This is obviously also a big earnings week today, this coming week. And what I'm noticing is a lot of media companies will be reporting numbers like 21st Century Fox and Paramount and even some of the newspaper companies, the New York Times and so on. So it's going to be a nice follow-on on to what we heard from Meta last week, who talked about slowing growth in advertising. We'll see if we get a follow-through on some of those more traditional media companies.
Yeah, overall, this is a story of purse strings tightening and really the marketing budget having to be curtailed because CEOs are worried. They are looking into a recessionary environment. That's going to be dictated by the macro, what we hear from the Federal Reserve, from the micro, and also how globally exposed they are. I think the March higher of the US dollar is just something that's going to continue to hit some of these bottom lines.
I think what's so interesting when we talk about purse strings tightening, just the latest story that we have out from JP Morgan's Marko Klonovic, saying that global hiking cycle will end by early 2023, not even in early 2023, but by then. As we really think about the global nature of this hiking cycle and looking for that pivot, Carol.
Well, speaking of pivot, like how quickly do we get off that Fed meeting come Wednesday and then think about the monthly jobs report? And what does it tell us? Does it mean that we're a little bit more worried that maybe things are slowing down much more quickly? Or do we continue, Paul, to see a strong labor market and what that means?
Exactly right. It's been one of the amazing aspects of this recovery or coming out of the other side of this pandemic, how strong the labor market is. And I'm going to be looking at the wage number. Are we going to see some wage inflation out there in this economy? And if so, what does the Fed do in response?
It
also,
does.
Carol, tomorrow jolts, so we go even closer than Friday.
Exactly, right. There's so many. I think this is such an important part of trying to figure out whether or not those Fed moves are working. All right, guys, that's a wrap. That does it for our cross-platform coverage, radio, TV, YouTube, and Bloomberg Quick Take. We call it Beyond the Bell. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Yeah, no doubt about it. And our thanks to our TV colleagues counting you down to the market close on this Monday. But Paul, the labor market, like that's the next big thing. Like, do we start to see wage inflation come down or some weakness?
Yeah, and again, as Caroline was mentioning, the JOLTS report tomorrow, that's a little bit of a
We'll have to see.
We certainly
Industry heard arguments today in two pivotal cases challenging the consideration of a student's race in college admissions. The cases were brought against Harvard and the University of North Carolina. Former federal prosecutor and Loyola law professor Laurie Levinson.
You have a clear split between the conservatives who want to strike down affirmative action and argue for so-called colorblind admissions, and the liberals on the court who want to stick with the law that's been on the books that says that, in fact, race could be a factor so long as universities are looking at the whole person, a holistic approach to college admissions.
Again, Loyola law professor Laurie Levinson, a ruling is expected next year. It's not clear exactly why, but there is a shortage of a common antibiotic in the U.S.
Amoxicillin is commonly used to treat ear infections and strep throat in children. The Food and Drug Administration says there's a shortage. 4 drug makers that sell nearly all the amoxicillin in the U.S. have limited supplies of some doses of the liquid form of the medicine, which is normally used for kids. Now, the FDA announcement does not say when supplies might return to normal levels, and it's not clear if the increase in demand is because more people are getting sick or if there's some problem with producing the drug. In Washington, I'm Amy Morris, Bloomberg Radio.
The suspect accused of attacking Nancy Pelosi's husband with a hammer allegedly wanted to hold the House Speaker hostage and break her kneecaps if she lied. The Department of Justice today announced David DePape is charged with attempted kidnapping and assault. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much. Nancy Lyons in our DC newsroom and bureau. So I don't know about you, Paul. You always look pretty dapper around here, but there is, like, for women, we talk a lot about fast fashion.
Yes. I've heard of that concept.
I had not heard about fast furniture, although this makes complete sense.
It makes complete sense. So mass-produced furniture that sold furiously during the pandemic could soon be clogging landfills. Americans bought piles of furniture during the pandemic. Okay, I get that. With sales on desks, chairs, and patio equipment jumping by more than $4 billion from 2019 to 2021. That's according to market data company, and a lot of it will not survive the decade.
And just to be fair, this is a story from the New York Times. I read it this morning. Our Doug Krisner was sharing with us, and the title on it is "Fast Furniture is Cheap and Americans are Throwing It in the Trash." I mean, it has a lifespan.
Right. I mean, this is not
Having bought some of it, especially when I was first married, or
Right.
for those in college, I'm not going to name names.
Right.
You know who they are. It takes tricky to put together, but nonetheless.
Yep. You don't necessarily maybe need it. Maybe it doesn't last that long. And so I'm going to start looking when I walk back to Penn Station tonight, like I do, look on the side and see if I'm not going to see any desks, chairs, Pelotons or something, exercise bikes,
Right, exactly. Well, and it's funny, and they talk about a lot of it. People were buying, it was tricky to find furniture. People were jokes
Yes.
about you buy a couch and you're waiting like months. The e-commerce furniture market alone was worth more than $27 billion in 2021, projected to reach more than $40 billion by 2030, and that's where a lot of it was happening. But it is interesting that as this furniture, and to be fair, right, there are different cost points whenever you go to buy anything, and some things last longer, some things
And at the beginning of the
shorter.
pandemic, if we think back, I mean, you're kind of scrambling to set up an office. And a lot of people were doing that in a home office. Well, and what was kind of the man cave maybe became your office for a period of time. So you got to furnish that stuff. So anyway, fun story from the New York Times about, it's kind of fast furniture. That's a new term for me. I'll take that.
Yeah, exactly. And the one thing now that they're concerned about is now it's going to be like in all of the landfill dumps
Landfills, right.
and trash. So it's like the other problem as a result of it. All right, this is Bloomberg.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It is on to the trading month of November. Stocks trim their monthly surge. Bond yields jump today as investors await Wednesday's Federal Reserve decision for clues as to whether officials will be dialing back the pace of rate hikes as early as December. Big tech weighed heavily on the S&P 500, and today it was down 29 points, a drop of 0.7%. The Nasdaq 100 index down 1.2%. The Nasdaq Composite Index back below 11,000, down 114 points, down 1%, ending today's session at 10,988. The Dow down 128 points, down 0.4. Again, the S&P was down by 0.7%. 10-year yield 4.05%, with the 2-year yielding 4.48%. Spot gold 16.32 the ounce, down 0.7%, and West Texas Intermediate crude oil down 2%, 86.17 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for the update. Carol Massar, Paul Sweeney, we are live here in our Interactive Brokers studio, streaming on YouTube and on Bloomberg Quick Take. And we want to talk a little bit about making content stick out. That is increasingly getting tougher in a world where we are bombarded by material online and socially. Involved in this space is our next guest. Alex Cardinal is CEO at Article Forge. They use AI and deep learning in creating content. He joins us via Zoom in Baltimore. Alex, good to have you here with Paul and myself. So help us out. Tell us more specifically what your company does, the kinds of clients and customers that you work with. Just love some background here.
Yeah, definitely. Article Forge is a tool that, using artificial intelligence, you can basically give it any sort of input you want. It could be a keyword. It could be like, how to make money online. Why is inflation so high in 2022? And it will independently research and write you basically a high quality first draft entirely automatically using artificial intelligence. It's really used a lot by small businesses who maybe can't afford like a $20,000 a month content marketing agency to help create content for their website. Help them, instead of paying 10 writers, they can kind of do it themselves. Get rid of kind of the mundane work of actually getting ideas and thoughts on a paper, and then spend more time maybe taking that content and tailoring it for their audience, doing the research, the kind of more fun parts of content.
Alex, I've been accused from time to time of being a slow writer, and particularly gifted writer, but a little bit on the slow side. What's the timing frame for your technology in terms of if I needed 300 words on why inflation's so high this year?
Probably about a minute and a half.
Okay. That does it. Wow. That's so it's now we're a pretty big news organization here at Bloomberg, so we have some experience with automated news creation, and so just I know in general the challenge has been quality.
Yes.
How do you guys think about quality? How do you address quality? How do you define quality?
Definitely. So I'd say first and foremost, our tool is not meant to be quite as specialized as Bloomberg, where Bloomberg, or what Bloomberg might be using, where you might have one very, very narrow type of content. Let's say, I know AI is used a lot for writing stock blurbs, for instance, or you might have a template where you're oh, the Dow Jones went up by X% and down by Y%. This would be more where you can give it a general purpose, any sort of query you want, and the results are not going to be good enough to publish 100% immediately, but worse, you could maybe just take the total time to creation down a lot, where you're focusing just on the editing. So certainly if you were Bloomberg, you wouldn't just be going from AI to on the website like you would for something much more narrowly targeted, but just anything you want to write about, any idea that you have, anything where you're I wonder what this would kind of look like as a blog post. You can start from a really high quality first draft instead of starting entirely from scratch.
Hey, Alex, you keep saying high quality. Your website mentions it as well. I do wonder what that, to kind of piggyback on what Paul asked, what denotes high quality as your algorithms are working, and where does fact come into this and factual content?
Definitely. So for facts, a key differentiator for maybe how we approach AI is a lot of AI is like a very black box. It's very hard to figure out, like, why did it write what it wrote? Is it being accurate? Is it up to date? For instance, like if a model was trained in 2019, will it be able to write about, like say the invasion in Ukraine, which happened after it was trained, after it learned. So we've implemented, I guess, alongside the part that's actually writing the articles, this kind of knowledge search engine, which you can kind of imagine as like a search engine built for machines, so that as the AI is kind of planning out its article, it's able to constantly retrieve from like kind of the breaking news. And it's also internally, we're able to verify, hey, it wrote something wrong. We're able to trace back like exactly where it got that information from. And maybe that means like there's actually something incorrect on the internet.
But how do you determine where the source content is something you can trust?
Yeah, that's $1 million question. Google wonders the same thing every day. I'd say that in many ways, it's designed to be exactly like Google in that way, like a search engine, where it's looking at like the trust factors of the website. For instance, like something like Bloomberg would rate higher. But a lot of it's even to like having human labelers go through tons and tons of examples and say, this is what high quality looks like. This is what trustworthy looks like. And also just, we do a lot on the fact verification side as well. So we're verifying whenever we write a sentence with our model, whether it's accurate or not according to these sources. But you can also do it for the sources themselves and say like, well, is this source verified by other sources? And from there, you can kind of get a general consensus for this is what the internet deems as accurate or not. And of course, beyond that, you probably want to have a human specialist who's looking at the draft, the actual draft itself and saying,
See,
okay,
we
this
do
passes.
still need people ultimately, right?
Yeah, although, I mean, people are not infallible either. So kind of pick your poison. Do you trust the human or the machine more to determine if something is accurate or not?
So who's your typical customer?
Tends to be very small businesses where it might be like a mom and pop store where maybe they're selling like, I don't know, any sort of, it could be like furniture, anything you can think of, where they know they're probably supposed to have a blog and they talk a little bit about like the products they have. Maybe if it's a furniture store, like maybe they want to have like articles in the blog, like what type of furniture is highest quality, or the pros and cons of oak versus the pros and cons of like cherry wood. And they're focused really on actually building their business. They don't have time to be like a full-time content writer on top of that. And they also don't have the resources to pay a team of writers. So instead they might turn to a tool like ours, get those first drafts, and then they can just kind of convert it more to be in the language of their business, the style of their business, and it makes it like, and usually I would say we're trying to compete with non-consumption. We're not necessarily trying to like replace humans. We're trying to create content that otherwise would not have been created because the ROI was not high enough for a human to create.
Understood. Humans are expensive when you got to put them to work. We eat, we fed, we need healthcare, all that good stuff. Alex Cardinal, CEO at Article Forge, joining us via Zoom from Baltimore. Interesting, right?
Yeah, it really is. And then I like just cranking it out, then a human can maybe gussy it up a little bit.
I like that. All right, you are listening and watching Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Monday. Carol Massar along with Paul Sweeney and for Tim Stenovic on this Halloween. Coming up, we're going to talk a little bit about, speaking of Halloween, what are we all spending?
Yeah.
What'd you spend? Got a costume?
No costume, no candy. I mean, those days are, I think, in
Well,
the rear view.
I
know. But I'll tell you, around the neighborhood, the kids will be out and about, and I bet you there's this huge pent-up demand.
All right, we're going to talk about that with our next guest, the CEO of CoreSite, in just a moment. Right now, let's get back, though, to how the market's wrapped up on this Halloween Monday. Here is Charlie Powell.
Hi, thank you very much. And here's what's going on. Earnings after the bell. NXP Semi is forecasting revenue for the fourth quarter. That guidance is missing the average analyst estimate. NXP Semiconductor down 1.3% after hours. Shares of Avis Budget, they're driving higher after hours, up 5.7%. The rental car company reported adjusted EPS for the third quarter that beat even the highest analyst estimate. Stocks trim their monthly surge. Bond yields jump as investors await Wednesday's Fed decision for clues on whether officials will dial back the pace of rate hikes as early as December. Also, investors have a lot of questions about what effect the Fed rate hikes will have on the economy. J.J. Kinahan is the CEO of IG North America, and he was our guest right here on Bloomberg Business Week.
You know, it usually takes 6 to 9 months for these rate hikes to get through the system. So we're just starting to see, in my opinion, the beginning of some of the ramifications for the economy overall. I'm not doom and gloom by any stretch of the imagination, but I do think that you have to continue with a cautious note as we head into the year end.
10-year yield, 4.05%, with a 2-year, 4.49%. S&P down 29, a decline of 0.75%. The Dow down 128, down 0.4, and NASDAQ down 114, drop there of 1%. Spot gold, $16.33 the ounce, down 0.7%. West Texas Intermediate crude down 2.1%, $86.08 a barrel. Briefly, Delta pilots have nearly unanimously approved a strike authorization vote, giving union leaders the authority to call for a work stoppage once they have gone through steps set by federal labor law. And Bank of America has told its global markets employees they are required to be back in the office almost every day as the Wall Street firm seeks to restore some of the culture that prevailed before the pandemic. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much for the update. Lots of Halloween decorations, I know, up around my neighborhood. A lot going on. And according to the National Retail Federation, 172 million Americans will spend something like a record $10.6 billion this Halloween. We'll talk about that more in just a moment. In the meantime, we want to head off to Washington, D.C. President Biden getting ready to make some comments. Let's listen in.
Well, good afternoon. This is a very short statement, but a consequential one in my view. Putin's invasion of Ukraine in March set gas prices soaring literally around the world, not just here, but around the world. And because of the action we've taken since then, gas prices have actually come down, going into the Strategic Petroleum Reserve here at home in America. They're down more than $1.20 since their peak this summer, and they've been falling for the best part of the last 3 weeks. In June, the average price, not the most common price, but the average price nationwide was over $5 a gallon. Today, the average price for a gallon of gas is $3.76. That's adding up to real savings for American families, the difference between those prices. And this difference makes a difference in a difficult time. Americans across the country have stepped up to do the right thing. But not everyone stepped up. The oil industry has not met its commitment to invest in America and support the American people. One by one, major oil companies have reported record profits, not just a fair return for hard work. Every company is entitled to that, a fair return for the work they do or innovation they generate. I mean profits so high it's hard to believe. Now, the second quarter, the profits were really high, but the third quarter, last week, Shell announced that it made $9.5 billion in profits for the third quarter. $9.5 billion. That's almost twice as much as it made in the third quarter of last year. I think that's something. You think that's incredible? I thought, that's as good as high as it's going to get. Then along came Exxon. Exxon's profits for the third quarter were $18.7 billion. One quarter, $18.7 billion. Nearly triple what Exxon made last year. And the most in its 152-year history. It's never made that much profit. In the last 6 months, 6 of the largest oil companies have made more than 100 billion. 100 billion. And we had a little discussion about this, the three of us and others. 100 billion in profits in less than 200 days. That's not bad. And here's why this matters. I think it's outrageous what the size of the profit. Here's why it matters. If these companies were making average profits they've been making by refining oil over the last 20 years, instead of the outrageous profits they're making today, and if they passed the rest on to the consumers, the price of gas would come down around an additional 50 cents. If they're investing their profits at historic rates in their U.S. operations, then America would be producing more oil today, and prices would be down even further. But rather than increasing their investments in America or giving American consumers a break, their excess profits are going back to their shareholders and they're buying back their stocks, so the executive pays are going to skyrocket. Give me a break. Enough is enough. Look, I'm a capitalist. You've heard me say this before. I have no problem with corporations turning a fair profit or getting a return on their investment in innovation. But this is remotely what's happening. Oil companies, record profits today are not because they're doing something new or innovative. Their profits are a windfall of war. The windfall from the brutal conflict that's ravaging Ukraine and hurting tens of millions of people around the globe. You know, at a time of war, any company receiving historic windfall profits like this has a responsibility to act beyond their narrow self-interest of its executives and shareholders. I think they have a responsibility to act in the interest of their consumers, their community, and their country. To invest in America by increasing production and refining capacity, because they don't want to do that. They have the opportunity to do that. Lowering prices for consumers at the pump. You know, if they don't, they're going to pay a higher tax on their excess profits and face other restrictions. My team will work with Congress to look at these options that are available to us and others. It's time for these companies to stop war profiteering, meet their responsibilities to this country, and give the American people a break and still do very well. The American people are going to judge who's standing with them and who is only looking out for their own bottom line. I know where I stand, and I want to let you, I'm going to hear more from me about this when the Congress gets back. Thank you all very, very much. Appreciate it.
Mr. President, how is your call with the midterm elections with 1 week to go?
How was your call with Lula from Brazil today, Mr. President?
All right, pretty quick comments.
Lula from
Wait.
Brazil,
Yeah.
the president-elect. How was
Is he going to take a question? I don't know.
Get together and discuss what we can do together. He wants to focus on the environment, democracy.
All right, so he's just a quick question because we talked earlier about President Biden talking with Lulu of Brazil, right, winning the election over the weekend. And so it sounds like he was answering a quick question on that, but a little bit off mic. The key thing, though, is, Paul, and this was expected, the AP reporting on this earlier, that the president was expected to call on Congress to consider some tax penalties and other consequences for oil and gas companies. And he talked specifically saying the oil industry has not met commitments to invest in the U.S., but you and I were just talking about it's expensive.
It's expensive, and you need some government cooperation. I won't say support, I'll say cooperation. I'm not sure, I'm not in the weeds of the policy here, but if you listen to a lot of folks in the energy industry, they're like, we don't really feel like we have a partner in the government in building more capacity, whether it's refining capacity,
right,
you know, whatever, drilling more wells. And so therefore, that kind of puts a little bit of a cap on the supply of some of these refined products at a time when the world's reopening and at a time when we've got, as the president pointed out, the war in Ukraine, which is causing its own disruptions to the global energy supply. So I don't know, a capitalist would probably say that's what's driving gasoline prices higher as opposed to you know, these companies being greedy, or however you want to phrase it.
Right, he did point it out. He said the size of oil firms' profits are outrageous. So again, making some comments and saying he's going to work with Congress on oil firms' excess profits. Yeah, so it's interesting. The other time this comes as we are talking a lot about climate change and the result of fossil fuels' impact on our global climate, and so it's really hard for some of these firms, if you think about it, to make major investments when they know the pivot. Speaking of pivots, is in a different direction.
Yeah, it's interesting, and this war in Ukraine just accelerated it in Europe, but it's a global issue here. Everybody wants to go, or most people want to go green.
Right.
And there's a certain time frame to get there, but in the interim, you have to have a viable, fossil fuel infrastructure. That goes the argument.
Yeah, it's pretty tricky. All right, before we heard from the president, and you can hear more about his comments, just head to Bloomberg.com. But before that, we were talking a little bit about what's going on in terms of Halloween, and it seems like a record amount of money will be spent this Halloween, $10.6 billion according to the National Retail Federation. So let's get some insight on that and what it means maybe for the upcoming holiday season overall. Joining us is the founder and CEO of Coresight. She's Deborah Weinswig, and she joins us on the phone in New York City. They work with clients when it comes to the intersection of retail and technology. Hey, Deborah, good to have you here on Bloomberg. How are you? And tell us a little bit about what you are seeing when it comes to Halloween, first of all.
First, thank you so much. Honored to be here. Doing great. Getting ready for all the trick-or-treaters. And it is fascinating. So since the pandemic started, we began to track the consumer in the U.S. on a weekly basis and ask them about 40 questions. So, we've got quite a few data points at this point in the game. What's fascinating is as gas prices nationally, excluding diesel, have gone down sequentially, right, month on month, we've seen a pretty dramatic increase in terms of consumers' willingness to spend for Halloween, and also their excitement to meet up with friends and family, which, often is some kind of social gathering in place as well, where they will also spend money. One other thing to think about is that the calendar in some ways works incredibly favorably for Halloween this year, where, you kind of had Halloween revelers out Friday night, Saturday night, Sunday night, and now Monday. And so it ended up turning into quite a long holiday for, the retail industry.
There's a lot of people out over the weekend, starting Saturday morning, whether it was kids, even adults, you could tell there's a lot. Like, this was a long Halloween season, party season.
I think we needed it in some ways. I mean, I even saw people the weekend before, and so, right, they were in full costume. And I think that there's this idea we're getting out, we're celebrating, we're having fun, and we're dressing up to do it. And one thing that's fascinating as we think about, holiday, is that many retailers whom we work with and we follow were sold out of Halloween in August. And they couched it, right? Do we kind of get back into business, or do we just kind of, run with what we've got? And many of them, to their belief in terms of the strength of the economy, is that they actually went and got back into business, and they said they sold out again in some cases. So I think that when it comes to celebrating, being with friends and family, we are seeing, the consumer is spending in that area, and we believe that will continue. This is a very positive, this close. Holiday this year started like October 1st, so we now have holiday and Halloween overlapping as well.
So, Deborah, what does that mean for the all-important holiday shopping season? That's really the big thing for the retailers.
I think it's a significant positive. Like I said, every single week, if we look at the last 5 weeks, anything related to spending, to getting together has increased. Now, everyone is certainly being more budget conscious, right? Shopping, exactly what you think. More at the dollar stores, right? At the clubs where you get, kind of the lowest cost per unit. All of that is happening. But what we're seeing is this, kind of elation around, kind of getting together. So I think that when it comes to spending to, have people over, to go out, it's really limitless. And, the fact that we saw such strong spending around costumes and home decor, once again, it's in almost every category. And that's what really makes me positive about Holiday 22.
How do we, when you look at what's going on in spending, whether it's for Halloween or the upcoming holiday season, what does it tell us potentially about the state of the American consumer right now?
That is I have to share some numbers with you. I mean, this actually, I'm always about the data. So 5 weeks ago, 30.7% of people had gone to a shopping mall that week. This past week, it was 37.4%. And each week it increased sequentially. And so we're just seeing people get out and about more and spend when they're there. And I think that when we look at that kind of data and, consumers started, yes, we've seen the past 2 years, holidays started earlier for various reasons. This year it started early because everyone wanted to kind of be in that holiday spirit. So it's like we're going kind of holiday to holiday.
So, Deb, explain to me this concept. It's kind of new to me. Buy now, pay later. Is that just like the old layaway plan? And how does that impact retail sales? Is that a thing? Oh, okay. We dropped Deb.
I think she went off to buy some candy.
Exactly.
Probably ran
Candy's
out.
more expensive this year, I hear. Big time.
It's pretty amazing, right?
Yeah.
But I agree with her that I think people were tired of the pandemic, and if you can party and have some fun, why not?
Yeah, absolutely.
All right, our thanks to Deborah Weinswig. She's founder and chief executive officer of CoreSight, joining us on the phone in New York City.
All right, let's go to Charlie Pellet, right? Is that where we go to? Let's get a business update, see what's going on out there. Charlie, what do you have for us?
What I got for you is a down day on Wall Street. Paul, the Dow, the S&P, NASDAQ, all in the red. This update brought to you by SEI. Imagine your asset management firm's operational infrastructure as a competitive advantage. Let SEI show you how at SEIC.com/IMS. Stocks lower across the board today. The Dow, the S&P, NASDAQ all finished in the red. It is on to the trading month of November. Where has this year gone? The S&P down 29, a drop today of 0.7%. We've got the Dow lower by 128, down 0.4%. NASDAQ down 114, a decline there of 1%. Stocks trimmed their monthly surge. Bond yields jumped as investors await Wednesday's Fed decision. 10-year yield 4.04%, with the 2-year yielding 4.48%. Spot gold down 0.7%, $16.33 the ounce. West Texas Intermediate crude down 1.9%, $86.22 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Masser, along with Paul Sweeney, here in our Interactive Brokers studio. So in a week where we get a read on monthly jobs, we'll start JOLTS tomorrow. We get monthly jobs on Friday, right? One group, though, Paul, that continues to have trouble getting a leg up, and that is women. We see this consistently.
Yeah, it is, and it's an issue that probably was exacerbated as an issue during the pandemic, but let's kind of flesh that out a little bit. We can do that with Shauna Hocking, founder of Hocking Leadership, joins us on Zoom from Philadelphia. So, Shauna, talk to us about kind of your report, what your findings are showing, and then we can take this forward.
Sure, I'm so glad to be here. What I'm learning and seeing from women everywhere is that we want to succeed, we want to advance our careers, and there are significant barriers to our ability to do that. And that the pandemic, I think in particular, has shown women that we're not willing to settle anymore for workplaces that don't value us.
So help me out here, Shauna. We talk to a lot of folks, and I feel like this has been a, forgive me, but kind of a chronic problem, not just this year, last year, pre-pandemic, but for years, that women just seem to continue to come up against barriers when it comes to the workplace. Things getting better, many would argue, but it's still pretty tough, and I can still count on my hand, maybe, the number of CEOs of publicly held companies that are women. So help me out here. What new things you're finding in your research, and maybe it comes off the pandemic that things are worse or better. Tell me what you're seeing.
I'd love to reference the recent McKinsey Women in the Workplace report. I think it has the most up-to-date information from women everywhere who are saying, we want flexibility, we want a completely revamped culture of work, and we want to continue to advance our careers, but only when there are companies who are willing to support us and value the whole person that we are. And I'm seeing that from my clients as well as from the research from McKinsey and Lean In.
What are, in your research, I guess, Sean, I'd love to get what you think is the top issue that can, in fact, be addressed. Where is some room for optimism?
Well, I am a rational optimist. I do believe that this is possible for us to work through this. I think what we did in the pandemic is we found that we had to create new models of work. And if we can continue to do that, and I know it takes time and effort, that when we begin leading for the world that we're working toward rather than from where we were, we'll be able to retain men and women in the workplace and help them thrive.
All right, you don't have to tell me or sell me that women are incredible and what they can do. But I'm going to go back to, like, as long as I've been doing this, and it's a fairly long time at this point, I feel like I've been talking about this issue over and over and over again. So I guess I do wonder, I think we did think the pandemic was going to be, wow, look, we can work flexible, hybrid. Women can work at home. It's easier since women tend to, when there's kids involved, they still tend to, pick up the bulk of those responsibilities. So I guess I'm like going to what Paul said, like, what is something that we could change right now, right here, that would really move the needle when it comes to women in the workplace?
I think the number one thing that we're seeing, both research and anecdotal, is to continue to embrace hybrid and remote work. Women are resoundingly saying, I can be successful in my job while doing all the other things that are important to me, reduced commute, caring for my family. And that means that we have to think about why organizations are all of a sudden reverting back to the way that we used to be when we are hearing these messages about how we can support our employees.
That's a great point, because I think we just heard today Bank of America is tightening up their back to work requirements here. But what is amazing to me, Deborah, during this pandemic and the work from home was how productive workers were across different industries. And I just think of the industry that Carol and I focus on, financial services.
Everybody got a lot done.
Yeah, I mean, I said, no way you're going to be able to trade government bonds from your living room. But sure enough, they did, and did it very well. I mean, what's the argument against that, I guess? That maybe you're hearing about coming back to work, and that might not be so supportive for women and others.
Well, first, I want to acknowledge that, yes, everybody felt more productive and also just more whole when they were working remotely or hybrid. And so what I think we're hearing now is that bosses and leaders are saying, well, I can't understand what my staff members are doing because they're not here and I can't see them. And I think there's a fear that people are really not working. But we know, to your exact point, that they were more productive than ever. And there is the sense that if you're in the office, that we will have a strong culture. And I firmly believe that workplace culture is about connections and not about presence.
No, listen, everybody talks about the importance of diversity, men, women, all gender, if you will, and certainly from different backgrounds. When it comes to minorities, though, and I know your research gets into for Black women, I mean, it's even greater, the barriers, correct?
Oh, absolutely. The barriers are very high for women, and particularly for women of color. Black, brown, Asian women, they are seeing all of this exponentially. And it's really something that we need to pay attention to in our organizations to help all of us thrive. That means that every group has to be able to thrive, together.
Are there certain industries, that do a better job of this versus others? I mean, is there some industries that maybe you think need to do maybe a better job?
I think that there are many organizations that are doing this well. I hear this from my coaching clients and organizations that I work with. So it's not necessarily the industry, it's about the leaders who are understanding I can't rely on doing things exactly the way I did them before, and saying this is going to require me to rewrite the rules of work. And I'm seeing that, fortunately, across industries, and that makes me feel hopeful.
Yeah, the other thing, though, I don't mean to be such a Debbie Downer. It's just, like I said, I feel like it's unfortunate. I do think things are getting better in some regards, but it's still really tough. What happens, though, if we see a bit of an economic downturn? That just puts more pressure on this, does it not, Shauna?
It does put more pressure on everything. I mean, organizations are being expected to do twice as much with fewer people. And I firmly believe that if we invest in our people, the outcomes will come. It doesn't feel like it makes sense, but again, we're rewriting the rules of work, and we're saying that this is possible in the future if we do things differently.
All right, Shauna, thank you so much for joining us. Shauna Hawking, founder of Hawking Leadership, joining us on a crystal clear Zoom call from Philadelphia. That technology is working.
I want that mic.
It's amazing. Mic envy.
Exactly.
Interesting about the markets here, Carol. Kind of a down day, but this is going to be a busy week. We've got a slew of earnings.
Yep.
That's a CFA term, slew. We've got
Uber, Lyft reporting.
Yep. Yep, and just across the board, some more technology. We're going to get into some more consumer names, get a good read on the consumer. And then we've got the labor report on Friday. We've got the Fed on Wednesday. There's a lot for this market to digest this week. So it's a good thing Matt Miller's on vacation.
Think he's checking in on this?
No, he's on the other side of the globe doing something. I don't know.
Well, and I'm curious to see that, disappointments, weaker economic data points or weaker earnings reports, how that will be read by the markets.
Yes.
Does that mean a softer Fed? And that means maybe we're coming to the end of this rate hiking cycle. And will that be seen as optimism, or will there be concerns about growth on the other side, considering the run up? And I'm just talking the equity space, considering the run up we've seen in the month of October.
October felt a lot like July, and that did not last. So we'll have to see. But again, it's all about the visibility, I think, for a lot of people in this market on this Federal Reserve. And of course, we'll get more on that on Wednesday.
All right. For Paul Sweeney, I'm Carol Masser. Tim Stanovic will be back tomorrow. Paul, have a great evening. And everybody else, you too as well. Have a safe evening. This is Bloomberg.
the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Wei Cheng in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, this week marks the beginning of a new chapter in the already long and twisty Elon Musk Twitter saga. Moves from the chief twit over the weekend, and what's next? Plus, Pinterest's latest earnings beat was a welcome bright spot